So let's dive into this. And it's actually, this is very, very good timing in terms of the current market we have, and really just kind of diving in and understanding how these current markets are working, what's driving them, and what are the things that we need to know as, retail traders, right? So what we're going to talk about here is the idea that, hey, how, and I call them profit accelerators. And you'll see why I call them accelerators here, because essentially we're able to take what are normal, I would call them normal concepts, and extrapolate them into ways to tweak your own trading results and kind of accelerate the profit portion of the trading, which is kind of, that's the part we want to accelerate. And this was a snapshot too, just so you guys can see where the account is and everything like that too. I do really trade. You've got an account number. I started the year with $117,000. We made $152,000 in trading profits, less $6,500 in commissions, leaves a balance of $263,000. So net return of $118,000. Now I did get stopped out of Netflix and NTS today, so that took it down to about 12%, right around there. So that was so that does obviously fluctuate, but the goal is, of course, a steady uptrending equity curve. So the idea with this then is, this is not about Ken. That's a good question, and I'll get to that. The idea with this is, it's not about one huge trade. Okay, and this kind of market is, it's not about like, okay, let's just wait and find one huge trade and that's going to make the year. Okay, and look, it happens once in a while, and when it does happen, it's great, but you can't count on that. Okay, that's not something that you can bank on. That's not something that you can plan for. Right, when it happens, it's great that when it happens, but you never know, is it going to happen next month? Is it going to happen in 10 years from now? It depends on a lot of things. Right, and obviously it's not always about buying the dip. This current market, it's been up, but it's been volatile. It's been down hard. It's been sideways. Okay, so the key is, no matter what's going on, is to identify the environment and adapt quickly. And at the end of the day, it's about steady winners and cutting off losers at the knees, and utilizing setups that continue to give an edge over the machines and the markets in general. So when I talk about big trades, okay, and part of it, I think, was one of the fun things was, a couple years ago, got into my Tesla trade, and it was the first day trade I'd ever had done that made over $1 million. Okay, look, that's great when it happens, but you can't bank on it. And the other thing about a trade like this is that emotionally, that's a tough one. If you're doing that every day, it can really shock a lot of people and wear them out. And so what you want to do is set it up where it's like, okay, well, it's great when that happens, but if we're not looking for that huge trade, how can we get steady gains without a lot of stress? All right. So at the end of the day, this is about a strategy. It's not just sitting back and hoping for the best. It's like, oh my God, this will work out great. This is going to be a huge trade. I don't have to make any adjustments, et cetera, et cetera. So it's critical to know how institutions work, okay? You've got to know what their game plan is. You got to know essentially what their charter states that they can and can't do based on liquidity, okay? And that's what drives a lot of this. And we want to know how money flow impacts the large stocks within each sector, and that's something I'm going to dive into. And we also got to have to realize that the indexes, we want to know when they're taken over by the machines and they're sideways and sloppy, versus when stocks are free to adjust to new price levels, okay, based on normal supply and demand. So the key has been to find stocks that have a strong correlation outside of the markets, which is what we talked about in January, or this is the part that I'm going to be talking about tonight. It's been a lot of fun, is how do you find stealth moves within key sectors playing on the same playing field as the institutions, okay? So I'm going to dive through this real quick. So for those of you that are newer to Simpler, newer to trading, stuff like that, got a couple of slides here where we want to just talk about some key facets of becoming a top trader in general before we dive into the strategy. Okay, so what are the keys to becoming a top trader? Well, you've got to learn how to use leverage in a way that grows an account safely and quickly. Okay, what's nice about when you do this correctly, you've got limited losses followed by unlimited potential gains. The reality of course, is that I've never seen an option go to infinity, but I have seen options move multiples, okay, of whatever the investment that you made in it. You have to develop or utilize proven trading setups and systems as part of your daily money-making routine. Okay, and the key with this is that you've got to learn and understand how to shadow the institutions. That way you're moving with the tide, you're moving with the flow, and not against it. Knowing when to trade normally and conservatively, and knowing exactly when to hang on for the big trade. I'm super excited to show you something that makes that extremely, extremely easy. Knowing how to minimize losses when a trade isn't working, and what percentage of your capital to put to work, keeping your drawdowns to stress-free levels. This is important, especially on a day like today. A day like today when you're positioned correctly is like, okay, great, not a huge deal. If you had the wrong options on, or you had a way too big of a position, it's like, oh my God, that was no fun. And that's a big part of this as well. So why options? I trade options, stock, futures, currencies, Forex. Options are my favorite simply because you've got a very, very good tool for limited risk. Okay, so you never have to wake up with an unexpected disaster. You can know exactly how much you're willing to risk. Okay, and you can trade small. And I don't think what people realize is that, if you've got a large account, or even a 10K account, how much of that do you need to risk to make 120% a year? You don't need to risk. You don't need to put more than $1,000 of that at play, meaning you can be at 9K in cash all the time. Okay, so there's no reason to actually bet the farm on this stuff. So safety plus leverage, that is the key. Okay, so I'm going to fly through this part real quick for those of you that are brand new to us, brand new to me. This is, I grew up in a military family. That's my dad, Vietnam, grandfather, World War II, great-grandfather, World War I. And it's kind of a cool military history. I've got a book out called Mastering the Trade, and that's something that kind of talks about the life lessons learned in trading and different things like that. I did spend some time on the speaker circuit in CNBC, and then and I've had a chance to kind of do some really cool trips and meet some of my heroes. I do some work with Richard Branson in terms of hedging oil and doing some currency trades, which is fun. But then my wife went and got pregnant, and I got kids and realized that I really don't want to miss them growing up. So I stopped doing all that. So we focus on that, do some mission and charity work. And at the end of the day, I trade. So someone was asking like, hey, how'd your account do last year? I like to start off the beginning of the year with about $125,000 and see what I can do. So here's last year. Okay, I'm going to try to do that again. I don't know if I'm going to be able to or not, but that's what I like to do. I like to look at the markets and see what I can do. So the idea with this is not looking at complicated option strategies, okay? I like simple strategies. They're easy to place, easy to manage, and easy to exit. The setups I like have a premise of buy a call if you think it's going to go up, and buy a put if you think it's going to go down, okay? With, and this is important, the ability to accelerate returns with tweaks such as adding a spread if that particular stock warrants that, okay? And we'll talk more about that. At the end of the day in this market, if you're only looking at the chart of the stock you are going to trade, I'm going to say this again, if you're only looking at the chart of the stock you're going to trade, you're being set up to get run over by the institutions who are focused on the sectors, okay? So at the end of the day, there is no need to sit there and look for that proverbial needle in the haystack. This market can be remarkably easy if you know how it works, and most importantly, how it moves. And to understand this, you got to know what the big money is doing, okay? Is the big money, somebody like Templeton or Dalio or Paul Tudor Jones, are they day trading? No, they leave that to the high frequency trading firms. Okay, those guys own all time frames under 5 minutes. The big funds are not trying to compete with them, and neither should you. What about, are they trading the indexes? They are, but they're doing it for more long term, okay? And in the short term, the 5 minutes from here and there, again, it's dominated by algorithms. It's dominated by machines, and that's not something that as retail traders we want to even deal with, okay? It's just not, if you've got the fastest computers and the fastest internet connections on the planet, you've got computers making your decisions for you, great. But as a retail trader where you're just trying to make some extra income or double or triple your account, you stay away from this, okay? So then the question goes like, well, what do we do? So what we want to do here is we want to look at ways to mimic what the large institutions are doing with a subtle twist on, I think, some of the things that we've been doing in the past. And here is the reality of the situation, is that the big money is chasing the same stocks for one simple reason, okay? And it's this: they have no choice in the matter. So right here, we've got the 10 main ETFs that make up the S&P 500. These were probably familiar names. You got XLY, which is consumer discretionary, okay? XLP, which is consumer staples. XLE, which is energy, financials, etc. And you can see the daily volume here, all right? They are highly liquid sectors. Now, this is also what drives funds returns, rotating in and out of these sectors. Most funds are too big to own more than 1% of an individual stock due to liquidity. So what does this mean? This means that if you've got a $100 billion fund, you can't own, all of Google. Okay, you can only own a small sliver of Google, maybe 0.5% of Google. So if Google has a great run, it's great. It's going to help your portfolio, but it's not going to make a big impact. Okay, they can't put too much concentration in one stock, because if you think of it this way, you and I as retail traders, we can get in and out of a position with the touch of a button, with the click of a mouse. If you're a fund and you own, 30 million shares of, pick your stock, it's going to take you sometimes weeks and months to get out of your position in such a way that you're not disrupting the market, okay? You keep that in mind, because that is actually how a lot of these markets trend, based on the timing of sells and buys of tens of millions of shares of stock in such a way that it doesn't disrupt the market, all right? So if you look at this from a return standpoint, you can see where money's flowing. So over the last month, consumer discretionary has been up 2%, energy's taken a hit, and you can see that money has been flowing into consumer staples, okay, healthcare, financials, real estate, tech, and the utilities. All right. If we look over the last year, you can see that the financials have had a huge bounce. Okay, and we can see that from the Trump election, where money started flowing into that. Okay. All right. So that's great, but how does this help us, right? So here's the thing that I want you to start to think about, and that is this: the way stocks are set up. And it used to be that energy was actually a pretty big part of the overall markets. And what's happened here is that the energy sector has shrank considerably. Okay, so if you look at how this market is made up, tech dominates. Okay, almost a quarter of the entire market is tech. Okay, and then 15% is financials. All right. Healthcare, 14%, and then consumer discretionary is another 12%. These four sectors alone account for 65.20% of the S&P 500 stocks. So guess what? Guess where a lot of institutional volume is flowing? In and out of these sectors, and it can rotate in and out of these sectors. Why? Because they're big, and two, because they're liquid. All right. If you look at real estate, it's a small section, because it's, frankly, it's not that sexy and it's not that liquid in comparison to these. So the reality of it is while there's 10 sectors, it's really narrowed down to the biggest ones where the volume is concentrated. Okay, and this gets even better, even hairier. So now, if you look at the sectors, okay, if you look at this chart here, and this is a very, very interesting chart, is that the bulk of institutional money is chasing only the biggest stocks in each sector. Why is that? It's liquidity, okay? So if the tech sector is rallying, and remember, the tech sector makes up 24% of the S&P 500, well, guess what? Apple makes up 14.97% of XLK, okay? Microsoft makes up 10% of XLK, Facebook almost 7% of XLK, AT&T 5%, and Google 5%. And then from there it starts to drop off. Like the 100 stock in there is like 0.023%. Like who cares, right? So all of a sudden now the universe and the playground that the institutions can get into has narrowed even more. So not only are they rotating in and out of, say, technology into, financials, but they're focusing on the top holdings because that's where all the liquidity is. That's where all the action is. All right. Does that make sense? So this is something that became very, very interesting in terms of looking at, what makes sense here. Okay, what is going on? What's driving these markets? So why is this important? When institutions are rotating into one sector and out of another, the question is which stocks are going to get the most action? Is it going to be the smallest stock within the sector or the biggest? Okay, well, guess what? It's going to be the biggest. So here, you can see today, right? Today, XLF, which is the financial sector, was down 2.89%. Okay, you'll notice that the fifth biggest stock, or it was like a top, I can't remember if it's the fifth or the sixth, it's the top 10 holding, was down 3.77%. Actually, a larger factor than the index itself. While T. Rowe Price, which is like, I don't know, I think it's like the 80th biggest stock in the sector, and represents 0.66% of it, okay, was only down 0.95%. This is what happens. When a sector rolls over and dies, the top 10 stocks usually get hit with a bigger portion of the selling because that's where the liquidity is, while the smaller ones move in a smaller amount, okay? So if we look at, say, financials today, you can see now Berkshire Hathaway, it's classified as a financial, but of course they're a pretty diversified company, so it doesn't get hit as bad. But today, with financials down 2.93%, if we look at the top 10 holdings, we can see that JP Morgan matched it, Wells Fargo exceeded it, Bank of America exceeded it, Citigroup was kind of right in line, Goldman Sachs exceeded it, right in line, Chubb had the only differential there, exceeded. So in general, the top 10 holdings moves are going to be bigger on the upside, but also bigger on the downside, okay? That means that we can get some power in those moves, and we know that when there's a move in a sector, where the action is going to be in terms of individual stocks, because the institutions have to go to where the liquidity is if they're going to be able to play this game, okay? So now, so goes the sector, right? So from here, so goes the sector, so goes the top 10 stock in a big way. And as I was going through this, and then I was looking through all this, and I'm talking to Henry, talking to Bruce, talking to Chris, and like, hey, what do you think about this? This got me to thinking, and I just started asking because I've never really, it's easy in trading to make assumptions, right? And so I started asking, is it the indexes, okay, that drive the sectors? I.e., does the spiders, does that drive, technology? Or is it the sectors that actually drive the indexes, i.e., is technology driving the spiders, okay? Or on that note, does the stock drive the sector? Okay, so let's look at Facebook here. So if Facebook is moving, is that what's driving XLK, or is it the sector that drives the stock? Okay, and so that kind of led me down, and this is what trading is all about, is you get some ideas, you understand some nuances, and this is from looking at the markets for tens of thousands of hours and starting to pick up on nuances that give you a slight edge. And so I started going down this rabbit hole. So first, I wanted to start with the basic setup that I like to use, okay, and the squeeze is an easy one. It's hard for me to look at a chart without the squeeze. So for those of you that are newer to Simpler and what we do, this is a powerful setup that I like. Essentially, these red dots, okay, what they do is they represent a compression of volatility. And the red dots make it very visual. You can sit there and say, oh, great. Wow, Tesla's got some compression of volatility. Well, what happens with volatility when it's compressed? It gets compressed to the point where it builds up energy, and then it has to be released, and then it releases an inordinate amount of energy, okay? And so how this works is that when you have the red dots, it's compressing energy, and when you see that first green dot after the series of red dots, it's signaling that the energy is now being released. If the histogram is above zero, it's being released to the upside, and if the histogram is below zero, it's going to be released to the downside. Okay, so and I know some of you guys that if you've been with us for a while, you're like, I got it, I got the squeeze. Okay, so how does this tie in? So this is what I started thinking about. It's like, okay, so here's the question. So here's Facebook, right? here's Facebook. Here's XLK, that's technology, and here's the Qs, which is the index. All right, so index is the big one, followed by the sector, followed by the stock. And what you'll see here is like, okay, well, great. When there's a squeeze here on Facebook, right, it has a nice little move higher. And when there's a squeeze here, on XLK technology, it has a nice move higher. And by the way, it goes both ways. The squeeze triggered short, right? So it went down. So it's like, okay, so if the Qs, the Qs move, and then we're seeing the technology move and we're seeing Facebook move, okay? So the questions I started asking is, we can see that each market experiences its own squeezes, okay, independent of the other ones. But my question is which ones impacted Facebook the most? Squeezes on Facebook only? Squeezes on the Qs, okay, and Facebook? Squeezes on XLK and Facebook? And the other question is how much does a squeeze on XLK by itself impact Facebook? Okay, so that's the kind of stuff where, I get excited about that and I'll tell my wife about it and she's just like, and God bless her, I mean, she does try to act interested for at least 30 seconds, but then after that, she has no idea what I'm talking about and she's not interested. So it's glad to be here tonight talking with traders so I can kind of show you what I found. What is exactly by a squeeze? So a squeeze is like a squeeze of volatility. So it's like the volatility gets so quiet. It's like the analogy I give it is like when you hold a puppy. Right, puppies like to squirm, and when you hold it, it'll sit still for like a minute, right? But then it's like its energy compresses, and then it just starts to squirm, and it has to release and go. And that's kind of stocks do the same thing. 80% of the time, stocks are meandering. They're going up, they're going down, but there's no conviction. 20% of the time, they have conviction, and the squeeze helps you pinpoint those moments of conviction because that's when you're gonna have the biggest moves. All right. Okay. So my original thought with this is that it would make sense that the biggest moves happen when. All right. So, and what do you guys think? So this is what I thought. I thought the biggest moves would happen when an index. Okay. So let's call it the S&P 500 or the Nasdaq. Okay, has a squeeze, and a sector within that index, let's call it XLK technology, also has a squeeze. Then and only then would one of the stocks in the top 10 holdings in that sector make its biggest move because it also had a squeeze. So that's what I wanted to find out. I'm like, okay, I'm not going down a rabbit hole here that is not going to really make any difference, or am I going to stumble on some things that are like, oh my gosh, I didn't know that this was the case. So take a look at this now. And this first finding here wasn't that surprising, okay? Frankly. So here we have here's a squeeze, right, on the S&P 500. Right? And here's a squeeze on technology, all right? And then here's a squeeze on Facebook. So not surprising when there's a squeeze on the spiders and technology and Facebook that they all three enjoy a rapid rise higher. Does that make sense? And I wasn't frankly surprised to see that. The one thing about that is that it's actually it's just rare when that happens. It's like, okay, well, that's great that it happened, but my gosh, it doesn't happen that much. So, but then that got me to asking other questions too. So from here, then it's like, okay, so even though it can be hard to find this, right? And that's the toughest thing with this stuff is how do you pinpoint when all this is happening? So it can be hard to find when an index and a sector and, a corresponding stock are all in a squeeze together, okay, especially on lower time frames. Now, if you're looking at like say a weekly chart, not as big of a deal because those take months to unfold, right? But if you're looking at a 30-minute chart, it's easy to miss that. So what I found that when they do line up, they're powerful, but they're hard to find, okay? And it just doesn't happen all the time. So then I started asking, well, what about just a stock and a sector together without the index, okay? How often does that happen? And is the result powerful? And then I was pleasantly surprised to say, okay, well, cool. When here's XLF, okay? So XLF is the financials, all right? Here's a squeeze. And guess what? Berkshire Hathaway, Warren Buffett's company, also had a squeeze, okay? And you can see here that when XLF took off, then Berkshire Hathaway took off, and that made sense. And what I liked about this was now I had a legitimate kind of like, all right, if I can actually focus on a sector and a stock within that sector, both having a squeeze at the same time, then it doesn't really matter what the index is doing. Okay, does that make sense? So, it could be something where money, this is telling me that money's about to flow into financials in a big way. It doesn't mean it's flowing into technology. It doesn't mean it's flowing into healthcare. It is flowing into financials. And that's where I want to focus, in this particular moment, because when I see that happen. So excellent. Okay, so this made sense. So when a sector and a stock squeeze together, even without the index, all right, and this is the key part of this, even without the index, you get an equally powerful move. Okay, that's awesome. Even if the stock market is trading sideways. Okay, that's important. That's important. We'll come back to that. So then I asked myself, what happens when a sector has a squeeze, but one of its top 10 holdings does not have a squeeze? All right, let me repeat that again. What happens when a sector has a squeeze, but one of its top 10 holdings does not have a squeeze? What happens? Okay, take a look at this. Here is XLF, the financial sector, right? Big old squeeze, huge move in the sector. What happens to Goldman Sachs, the number 6 holding in XLF? Big, huge move and no squeeze. This was, to me, this was awesome. It's like, wow. So here is a situation where the individual stock had this huge move, okay? And because I scan for squeezes based on the stock, this is a move. It's like, wow, I wouldn't, that's not a move that I would catch because there wasn't a squeeze. However, what I've seen now is, irrevocable proof that if the sector is strong, then the top 10 holdings are also going to go. Does that make sense? Yeah, exactly, Eric. Coattail riding. So I was super excited about. Paul, exactly. Paul saying those sneaky bastards are hiding their orders in the stock, then piling it on the ETF. Exactly. We're doing it. By doing it this way, they cannot hide. All right. No, and Danny, good point. I got other examples too, and I went through and looked at a lot of the stuff. Okay, so interesting. This got me interested in focusing on sector setups and then placing trades on one of the top 10 stocks within that sector. Okay, so check this out. This is Priceline. Now, a lot of people think Priceline is in the tech sector, but it's actually classified as consumer, okay, XLY. And you can see here that XLY has a squeeze and goes higher, but Priceline does not. What was fascinating about this when this happened is that tech wasn't doing anything. If you guys remember when Priceline was going crazy and there was no apparent setup and tech wasn't really doing anything, why was Priceline going crazy? Well, it's because XLY had a squeeze and popped higher, and Priceline is one of the top 10 holdings in XLY. So it looks completely unrelated, and it's important to understand, like Amazon is not in the tech sector, okay? Amazon is not in the tech sector, and it's important to understand that. These sectors are what are gonna be driving these stocks, all right? So that's something I found is like huge. So if you look at this, look at the XLY here, okay, and you'll notice here that a lot of times, we think like, okay, XLK, that makes sense. There's Apple, there's Microsoft. I bet Amazon and Priceline are in there too. And the answer to that is no. Amazon is the largest holding in the consumer discretionary spending, and Priceline is the 5th largest, okay, right behind Disney. So that's kind of interesting, and I think that they're actually incorrectly in that sector. Like they should be tech stocks, but what I'm starting to realize is that tech's dominating everything. So to be fair, like if they put everything in the tech sector, then the tech sector is suddenly 80% of the market. This is a way for the funds to balance each other out a little bit. Okay, so yeah, so to me that was pretty awesome. All right, so then I kind of started thinking some more. How powerful is a stock squeeze by itself when it doesn't have a sector or index to back it up? Okay, so here's Facebook. And what I was getting at here, so for those of you that are newer, the squeeze like this it has a success rate of about 75% to 80%, depending on, it's like if it's above the 21 period moving average and stuff like that too. But what I notice is, let's call it, 20% to 25% of the time, it's a dud. Okay. It's not that it's not that, oh, here's a long signal and it drops like a rock. It just doesn't do anything. And in this situation, if you buy a call and it goes sideways, you lose money, right? Because the premium decay. If you bought the stock, you didn't lose money, but you didn't make any money. So then I just got really, really interested in the idea of, okay, what all needs to come together here to have a big move. So at this point, if you guys know Eric, I called up Eric and said, hey, look, I know you've got your 6 children down there by the coast. Can you hop in the car and drive to Austin? We got to talk. I was like, look, I have a dream. I want to be able to look at multiple sectors and indexes at the same time on different time frames of my choosing to see if anything is setting up in a squeeze together. So we went back and forth, and Eric said, give me 2 weeks. All right. And so here's what he came back with. Now, remember that Facebook squeeze, it didn't work. All right. So here's what Eric put together. And by the way, this looks kind of like, if you guys are familiar with multi-time frame analysis, this is not it. I'll talk more about that. All this is doing is providing an easy way for us to say, is it in a squeeze or not in a squeeze? Okay. So in this case, I've got the spiders, the Qs, IWM, the transports, financials, technology, energy, consumer stocks, healthcare, and you can see them right up here. And when Facebook fired the squeeze, okay, now we can look across all the other sectors on the same time frame, the 195-minute chart. And when this thing fired a squeeze, the spiders were not in a squeeze, the Qs were not in a squeeze, okay? IWM was in a squeeze, but that doesn't really matter for Facebook. And then energy was in a squeeze. So essentially, Facebook was all on its own. Okay, does that make sense? Facebook was all on its own there because there really wasn't any squeezes setting up on other key sectors or indexes on that time frame. Okay, on that time frame. But now, if we go back and we look at, so I thought that was like cool. Okay, and first of all, my God, that saved so much time. And it brought everything together very quickly. So let's compare that squeeze on Facebook with another one where it had sector and index action behind it. Okay. So here you can see it's like, all right, here's another squeeze on Facebook, right? It's setting up, squeeze, squeeze, squeeze. And if we look up here, we can, and it starts from, this one is the last one, right? So biotech didn't have a squeeze, which doesn't really matter for Facebook, okay? Healthcare didn't have a squeeze, which doesn't really matter. Energy had kind of had a squeeze here, but that didn't happen right here. That's energy. Consumer, that doesn't matter. But right here, you can see that the tech sector had a squeeze. So it's like, okay, cool. On the 195-minute chart, Facebook had a squeeze and technology had a squeeze. Now, it happened to be that financials had a squeeze, but that doesn't really matter. But that's, that's like, hey, if the more the merrier. Transports did not have a squeeze, didn't matter. Russell didn't have a squeeze, but the Qs and the spiders had a squeeze. So we had a situation here where Facebook's in a squeeze, the spiders are in a squeeze, the Qs are in a squeeze, and the technology sector's in a squeeze. Now look at the difference in this one. Boom. Now the squeeze is over when it loses momentum. Okay, so it starts here, and as long as the momentum is light blue here and going higher, it's still valid. And then you can see here, it's like, oh, okay, time to get out. So Facebook here moved from like $123 up to like $133. You scale it along the way. It's like, wow, not only what a powerful move in the stock, but what a nice, clean way to find when we've got a lot of things like that setting up. All right, does that make sense? So the idea with this is, yeah, the triple squeeze, because they're like, oh man, there's 3, and in a perfect world, it's like, okay, the index, the sector, and then the stock within that sector are all in a squeeze, i.e. triple squeeze, right? But as we saw, there's a lot of things you can do with the sector itself. So here they are side by side, just so you can kind of get a sense. So you got, here's a squeeze, this squeeze over here, where there's a triple squeeze action. That's actually a quadruple squeeze. And then over here where you don't really have anybody helping out, okay, and it's on its own and it kind of fizzles. So I thought that was super powerful. So now suddenly here's a way to filter, like, okay, look, here's a squeeze coming up. On this one, either I could pass or at the very least I would just sell some puts, right? Over here though, I'm going to buy some calls. I'm going to take a bigger position, okay? Okay, now one question that may come up for those of you that are familiar with our multiple time frame analysis tool, these two look alike, but they actually have absolutely nothing in common. So, which is, it's kind of like how many different colors can you use? But over here, just so you guys know, what this is doing is saying like, hey, the daily time frame is bullish, the 2-day time frame is bullish, yada yada yada, and the red dot means it's bearish. So if we look at NetEase right now, we can see like, wow, every time frame is bearish. So that has nothing to do with the squeeze, whereas over here, green means not in a squeeze and red means in a squeeze. Okay, so I have to admit it's confusing, but they're completely totally different. But in case that was coming up as a question. All right, so very excited about this tool. So now I can look at up to 10 different indexes and sectors of my choice as I'm moving through my stocks, okay? And the key with this is on any time frame, all right, on any time frame. So if I look at a daily chart, and then I switch to a 30-minute chart, boom, I'm gonna see if there's any squeezes on the 30-minute time frame on any one of those as well, which is super awesome. So what we want to do here is we want to play by the institutional rules. And so once we set this up, it's like, oh my God, I'm super excited. I want to find the stuff. I want to put it together. Then I started thinking like, all right, what is you remember when I talked about earlier, and if like a fund has a huge position, they've got to sell it in such a way, all right, and they've got to buy it in such a way that it doesn't disturb the market. And what I found is that if you guys are familiar with one standard deviation moves, and that's essentially, it's about 70% of the time a market's going to stay within, one standard deviation and kind of come back and maybe go up another standard deviation the next week in a strong uptrend and then kind of come back. And that's why this happens. Okay, the institutions are doing this in a methodical way. But what I was curious about is like, if there's options, so you'll have like, say, here, let's look at Priceline. Let's look at, well, any stock. But if you look at the, expected moves, okay, I mean, essentially you'll see here, well, 3 days out, the expected move is plus or minus $1.60. 10 days out, the expected move is plus or minus $3, yada, yada, yada. And so my question was like, okay, well, which one of those is the most important? Are the institutions focused on the expected move for this week, or is the following week more important, or is the monthly more important? And I just had no idea. Okay, so I wanted to look at that. So here's what we found is that when a stock makes a move up or down and it tags the expected move for the next week out, okay, this is a screenshot from today. You can see that these are the options that expire this week. Boom, boom. These are the options that expire next week. And you can see now, obviously today's move was a little exacerbated, but what I've noticed is like right here was the same thing. Once it hit next week's standard deviation move, it was over, okay? Now today, the same thing happened. So what's interesting about this is that what happens is that what becomes in play, it's not so much the expected move of this week, it's the expected move of next week that is driving the markets in terms of targets. And if you look at this, look at XLK today. XLK is technology. Once it tagged that one standard deviation move, and again, this is not one standard deviation, two standard deviation, it's one standard deviation for this week, one standard deviation for next week, yada, yada, yada. And once it got to that level, it was done. Now, again, most of the time what happens is it hits that level and just pulls back. In this case, it hit that level and became a reversal. This becomes priceless for determining what? Targets and option strategy, all right? Here's NDX today. It hit that that one standard deviation level for next week, okay, options 10 days out, and it was done. So now what we can do is when we combine all this together, okay, and you combine this together, suddenly life gets very, very interesting. Now over here, you can see like, okay, great, here was a squeeze. And what'll happen is, like, when we got up to right here, you'll notice that the market went flat. Well, guess what? That corresponded with the expected move 10 days out from that time. Okay. Here, you can see that there is some squeezes that are developing. And when we got up here to that same 10-day target, it stopped and paused. And in a strong market, it'll ease back and wait till the following week to go to the next level higher. And you'll notice that these things move up like that. In this case, today, there was a lot of selling that came in, and it continued back through the 21-period moving average. So, and this happened the other day with Momo. When it popped up, you can see it came up pretty high right into those same levels, and then it was done. And so I saw this happening over and over and over again, and I was just very fascinated by it because it's a hidden level in the options. Okay, now this also acts as support, and I want to talk a little bit about Priceline. So Priceline, you can see it's been coming down today, and notice that the expected move for this week lines up with the 21-period moving average. That is very, very powerful, and that's something that I'm going to be watching. So the final piece of this puzzle was with options, what is the best strategy for the stock? And so you'll see this is a kind of a P&L tab of my stocks this year. Now, this doesn't represent one trade. I've traded Priceline like 10 times. Okay, I've traded Tesla like 8 times. This is the cumulative P&L by symbol. Okay. And what's interesting with this is that I've traded Priceline frequently this year, but the reason it is doing so well for me is partially based on the setup, but is also knowing what option strategy that works best with Priceline. Okay, so this is crazy. So what option strategy works best with Priceline? Well, on all those setups, by the way, there hasn't been a bearish setup on Priceline for a long time. So all those setups that I looked at were bullish. Well, guess what? Anytime I would have just bought calls, okay, with those setups, I would have lost money because of the amazing premium decay of this option. So had I bought Delta 90 calls, I would have lost 16%. Had I bought Delta 60 calls, I'd have lost 2%. Delta 50 calls, 16%. 40 calls, 27%, and of course, not surprisingly, out of the money calls, I would have lost the most. Now, if I did one tweak, okay, and if I just reduced the amount of calls that I bought and then added a put credit spread, look at the difference. This is the same setup, okay, same setup, boom. So in this case, the strategy that worked the best is you buy an in-the-money call, buy that Delta 70 call, but sell the at-the-money put credit spread. So now same setup, and instead of losing 16%, it makes 139%. Okay, this to me was like such an aha moment to be able to go back and look at the personality of that stock. Now with Tesla, buying the call by itself was fine. Okay. So each stock is a little bit different personality, and that's something that helped very, very much. Okay. So anyway, so that was kind of cool. So the idea with this is that the more you kind of hone in and have the right tools, the more you can have an equity curve. And look, on days like this, I came in today long, but based on position sizing and things like that, it's kind of like, okay, great. This is, it's a little move like that. And now I want to get back to, growing in the next little pop here, whether it's to the upside or the downside, using tools like this. All right. So that's what I got. So the idea with this is just that the tweaks here is just the power of tiny gains compounded over time. And you'll see that, like that Priceline example, yeah, on some bullish trades, buying calls works great, but on others, if you can back test it and say, well, gosh, if I could tweak it a little bit, that could, and I could get, say, 1% better every day. Look at how that compounds over time. And so if you start, like say right here, 1 year later, if you get 1% better every day, your account can potentially triple, versus 1% worse every day, you go to 0. Okay, so it's a little differences like that where you can tweak and accelerate your account performance. So at the end of the day, in trading, making money is, it's not that difficult. Once you have the good tools, making money it's fairly easy. It's just keeping it. It's knowing how to make the switch. It's knowing when to kind of get in out of a sector like that and do that. And I'm a big proponent of pulling profits out of the market and putting it into tangible assets, land or whatever you think. So based on this, so first of all, hopefully this was an aha moment for you. If you like strategies like this. You can take this stuff, you can go and do it on your own. For those of you that want to dive in a little bit more, put together a class based on a couple different things. First of all, if you are brand new to us and you're really not sure what we do, we're trying this little starter pack here. This is where I'm going to go through and I'm going to talk about, hey, this is a squeeze, all right? This is how over time we've developed strategies, the basic top 3 strategies that I like in how to trade, okay? And so it's really designed if you're newer to simpler. You can be an advanced trader, intermediate trader, beginning trader, but it's the strategies. How do you trade something like the squeeze and make money on it? From there, we're going to do a strategy class, and the strategy class is going to dive into what I've been talking about tonight in much more depth. Okay, we're going to go through specific examples. We're going to have checklists, when to get in, when to get out, talking specifically about how to set up the targets on the options using those tools and how to manage that. Okay, so this also will include a copy of the triple squeeze indicator. All right, so this will include this class if you'd like to do it, but it's a 5-hour strategy class where we're going to dive in soup to nuts, go through these sectors, go through these setups, how to set up your charts and find these things. All right. And then what's fun here is we've got a professional package, but it also includes live trading. Okay. So it includes live trading where we can sit there for 3 full days and do these trades live. And you can see exactly how to do it. This also includes that expected move indicator. Okay, that indicator is great. So you can see like where that 10-day target is and all that kind of stuff too. And then for those of you that like live events, we are going to have a live event in Austin. And that includes, of course, everything over here. All right. So let me just see if you guys have any questions. I'll go through a couple of other things here. But I've been super excited about this because I've always kind of, of course I've spent so much time looking at the markets, and I've always kind of wondered like, okay, if why is Goldman Sachs making this move, okay, out of the blue? Why is Priceline making this move out of the blue? That's part of it, okay? And this helped to really discover that. And then from there, it's like, well, how come on this particular stock when I buy calls, it works great, but on this particular stock when I buy calls, maybe not work so well. Okay, boom, now we found out how to deal with that. And then last, just the idea of like, what really is the level that the institutions are gunning for? How can I know if we get up to a certain level that that's an area that's going to be defended based on standard deviations? Is the weekly options, are they that important? Are they that critical? Or is it the monthly options that actually play the bigger role? And I was really surprised to learn that it's actually the options that are 2 weeks out. And there's some strategies specifically around options that are 2 weeks out that are accelerating my returns that I want to share with you as well. Okay? So that is, let me see what questions you guys have. So let me go, and I'll go through a couple of other these real quick. So again, if you're newer, what we're going to be doing is this is going to be on Saturday, March 25th, which is coming up, and we're going to be doing that strategy session for newer folks. If you're newer to simpler, you're not really sure what a squeeze is, et cetera, et cetera. That's where I'm going to talk about my top 3 setups. These are setups that I've covered, over the years, and combination of squeezes and moving averages and stuff like that. So at least it can kind of get you up to speed. It's only $47, it's 2 hours. And then after that, we're going to jump in, we're going to take a 30-minute break, and then we're going to dive into the strategy package, okay? And this is going to be from noon to 5, and we're going to dive in and do a deep dive so that at the end of this, you're going to know exactly what to do. It also includes that triple squeeze indicator, and if you would like to attend this class, intro class, you're more than welcome to attend that as well. And then from there, if you'd like to do the live trading, which is always fun, and by the way, we're up to, I think it's the last 9 live trading classes in a row where trading a 1 lot, people have been able to make enough money during the live trading class to actually pay for the class itself, okay, which is of course a lot of fun. This will be on March 28th, 29th, and 31st during market hours, okay? And that includes, of course, the Saturday class as well as that. And then last but not least, if you guys do like live events, I think live events are good just simply because you get out of your world, you get to focus with a group of people for an amount of time, and you just start getting insights. When you're so immersed in something like that for that period of time, you start making connections and getting insights that would normally take, it could take a year to get to that, but you don't have any interruptions. You're focused on trading, and that's going to be here in Austin, June 12th and 13th. All right, and we've got an awesome team here. They're ready to, they're ready to work with you, ready to talk to you if you have any questions. All right, so that's what we got. Let me scroll back up here. I'll put this on here, and I'll just kind of answer questions that you guys have. Happy to hang out here and go from there. Yeah, so the indicators we've got right now for Thinkorswim and TradeStation, and then we're also, I believe, in talking to David that he's also gonna. We've got for those of you that don't have those platforms, we'll also have them available on a web-based scanner. How much of your trades are income, i.e. selling premium versus buying calls? Okay, so great question. So it depends on, do I have something where it's like I've got a sector and an index behind it? Well, in that case, I want to get as much bang for the buck as possible, and I'll look at buying a call, okay? If, however, it is just the stock, then I'm going to look at selling, like say a put credit spread if it's a bullish play. The good news with this is that if your main goal is income, you can always just do credit spreads on any of it. But what'll be nice is that you'll know that, if there's sometimes, I don't know if you guys have ever done this, when you do this, when you do, say you sell a put credit spread, right? You sell a put credit spread, like let's call it on, Amazon, all right? And you sell, the 800, 795 put credit spread for 50 cents, your one standard deviation out. And then Amazon goes up, $65 a share. Well, it's great. You made that 50 cents, but had you bought like one call, right? Or 10 calls, you'd have made $50,000. And so what I like to do is use this to pinpoint like, okay, well, my main goal is income, but once in a while when this happens, I'll also buy a couple of calls on the stock to see if I can accelerate those returns. What about Tastyworks? Any news on that system? Yeah, we are looking at talking to them about getting our indicators there as well. And I know what a lot of people are doing right now is that they'll keep, something at Thinkorswim. If you've got an account at Thinkorswim and went ahead with Tastyworks, we got a lot of people just doing the dual thing right now as Tastyworks get kind of caught up there. Your previous trading room software, I had firewall issues with my company. So Kevin, we've been launching some, and so for those of you that don't know, we've got a trading room with some new technology where pretty soon we're going to be able to start doing text alerts to you guys on your iPhone, your Android phone, stuff like that. Super excited about that. We're getting so close. Yeah, so Laurel, what's interesting is that this is something where, as I was doing this on my own, it would take me like an hour to find like one setup because you've got to look at all these different things. And then when I was telling Eric about that, he's like, "Oh, I can put something together." And now it's just like, what's happened is it compressed the amount of time by like 95% and was able to kind of really pinpoint this stuff. And it's like, so yeah, I'm super excited about it. How does this strategy work with the MTFA or the RAF? So a lot of these are complementary, right? What's interesting about, if we're looking at, say, and I'll look at all these, and if we're looking at the MTF, of course, this is based on, just different time frames, okay? And what I found with a lot of this stuff is, especially if you got multiple squeezes, and then if you got RAFs turning higher, it becomes even more powerful. So they work well together. And what I will do is during the class too, is for those of you that have some of the other indicators, show how they are working together and stuff like that too. Do you need to be on TradeStation? So I know for some of you that have like say Fidelity, okay, initially what'll happen is, I use Thinkorswim and I use TradeStation. We have put together, the good thing with it is that you can set it up so as long as you understand the concepts, you can still do it on the broker that you're using. We actually did end up putting together kind of a web-based scanner for people that may not have Thinkorswim, but would still like to see some of the same setups. And so then that's a tool that I'll cover as well. Can JC talk about risk management on his trades? That's definitely going to be a big part of what we're going to be talking about, absolutely, on Saturday. Is the indicator the one you showed tonight that shows sectors? Yeah, okay, so good question. So here's the indicators we're talking about here. So let's see. Now I've got so many charts opened up on my screen. And I'm going to find, there we go, and boom. So, so what we look at here is, so the indicator that's going to come with the Saturday class is this one, okay? And then the indicator that's going to come with the live trading is this one. So if you do the live trading, you'll get this indicator and this indicator. And then if you do the Saturday class, you'll get this indicator, if that makes sense. And if you look at, if there's stocks you guys want to look at, and by the way, this works on futures as well. If you look at oil, you can see it's like, okay, here are the targets, that are setting up, or bonds, same thing, okay, or Tesla. And it's fascinating. Like, look at this on Tesla. You came right up to that second level today. I mean, I'm telling you, this whole part of what I'm going to be talking about on Saturday is this whole 2-week strategy that I kind of stumbled across in doing this. And what I found is literally by back testing is that, say, like, at the beginning of every week, you wanted to buy a call or sell a put credit spread on an option. If you actually did it every 2 weeks out instead, most cases, your profitability goes up by 50%. Okay. This is kind of a hidden, nice little move. Everybody gets taken advantage of, especially if they're newer, with options that are going to expire in like 3 days, but they're not paying attention to the ones that expire the next week. And that's where you can make the consistent money. All right. Yeah, and by the way, if you guys have any questions, let me put our phone number up here as well. This is going to be an awesome class, guys. It's going to be a lot of fun, a lot of stuff coming together on this class. And again, what I always like on something like this, there's no point in doing a class if it's tools that can't pay for themselves very quickly. Whether you just do the Saturday class and you get this tool, the idea that it's going to pay for itself very quickly, I feel very, very comfortable with that. And especially with the live trading when we can do it together. And that's always kind of fun. It's like, look, no matter what the market's doing, if it's having a day like today, or if it's going up, or if it's going sideways, we can find strategies with the goal of paying for the class itself. So our phone number here, one time I actually accidentally put my cell phone up here. That was awesome. 512, God, I almost did it again. Not that I don't mind you guys calling. There we go. Do you have something that lets us know what strategy to use for different stocks? Yeah, so part of the checklist I'll cover on Saturday is, on an individual stock especially, okay? If it's a bullish setup, it's typically there's 3 different choices, okay? And by the way, I'm not a huge fan of what I would just call more complicated option strategies, okay? And like on Saturday class, I'm not gonna talk about like a strategy called butterflies. But guess what? If you know how to do butterflies, you can use those 2-week levels to establish butterfly levels, right? I like to teach classes that are really geared for like anybody can benefit from it, no matter what your skill level is. And then from there, if you are more of an advanced options trader, you can take that technical analysis and say, wow, I could really actually, I could just go to town with some double calendars on this. Great, that's awesome. John, will anyone else beside you be doing the 3 days of live trading? So I'll be doing the bulk of it. Typically what we do on stuff like that is I'll do kind of the first 2 hours in the morning, and then the last 2 hours during the day. And then in the middle of the day, we'll take a break and typically have one other person come on and share some information as well. And part of it is just kind of like, resting. If I talk for 8 hours in a row, then it's like, I'm shot for the next day. So, but usually about 2.5 hours in the morning, 2 hours in the afternoon is pretty good. Good question. Are you going to be teaching fundamentals on options, like say weekly credit spreads? So what we'll be doing in that $47 class is we'll be covering some options basics. But what I want to emphasize is that it's not, when I say options basics, we're not going to be spending 2 hours going, this is a call and this is a put and you have the right but not the obligation, blah, 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 blah. You can look that up on Google. What we're going to be talking about is, here's a setup Once you understand the setup, then we'll talk about basic strategies. Okay, and what I found is that most people understand what buying a call is and what buying a put is, but they may not necessarily understand what selling a call credit spread is. And I've got some very simple tools just to kind of show, one, how those work, two, when it's appropriate. Can you tell the Minneapolis house story? I'm from Minnesota. That's such a painful story to relive. I will. That story actually takes a little while. I will cover that on Saturday though. It's that's a funny story. And honestly, it put me on the path of where I am today in terms of a focus on setups and a focus, end up working with Mark Douglas as a result of that, which is pretty awesome. um, let's see here. No, Bob, and that's a good question, Bob. And I think, give us a call. And that's something I do want to look at, because I know for some people, especially, if they're a little newer and you get into a point where it's like something's like really over your head, it's just being able to make sure that you understand it. And, and maybe something too, where we could do like an additional session for folks that are like, okay, this is a great strategy, but, I don't even know how to place orders on Thinkorswim. So, I think that's stuff that makes a lot of sense. Can you scan for a setup? So Quinn, the answer to that is we are going to be able to do that. I'm not sure. I'm not sure how easy that is to do within Thinkorswim, but we are going to have that added into the web-based scanner too. Dun, dun, dun. Yeah, oh yeah, it's a good question. Does it work with futures? So the nice thing here about so now with futures, okay, so futures is a little different, right? So with futures, if you're trading the S&P 500, you're not really looking for a squeeze on, say, it's like the stock market's a stock market. But what's really awesome about futures is I actually set up another one for futures where if I'm looking at the S&P 500, I can look at, guess what? I can look at the yen. I can look at bonds. I can look at gold. I can look at oil because they're all correlated. And guess what? When they're all forming a squeeze together, that's when the proverbial caca hits the fan. Okay. So it is a really useful tool for seeing multiple squeezes on the same time frame in correlated assets. Because sometimes what will happen is you'll get a squeeze on the yen, but not the stock market. But then the yen squeeze fires and the stock market goes nuts. So it's a very cool tool for doing that as well. Yeah, so good question too. A lot of strategies, based on the indicators. So what I like to do is so on any given day, there's going to be like 10 different strategies that you could use, right? I narrow them down based on, I'm really interested, what is the setup combination that's going to give me the potential for the strongest move in the underlying, okay? And I'll talk more about this on Saturday, but it's like, if I'm looking at, say, like 10 setups, a lot of times like, okay, here's 10 setups. Why are you taking this one? It's because of the potential of that move based on the other ones. It may be something where it's like, well, Facebook also has a squeeze in technology and it has a squeeze in, but it's also the setup here. You've got, stacked moving averages and yada, yada, yada. So it's having a checklist of going like, okay, given these things of these 10 setups, which one has the potential to be the most powerful? And I've been getting a lot of questions about that. We're going to spend some time going through that on Saturday. So, it's a good question. Let's see, what else? And looks like I'm a little delayed on some of these questions here, but so what exactly is the triple squeeze indicator? Let me grab the chart here. So the triple squeeze indicator is this, that just shows like, now you'll notice here, it could actually be called the 10 squeeze indicator, but generally if 3 of these are lined up, if you've got a index and a corresponding sector and the stock, you're going to have the biggest moves. All right. Fantastic. Let's see what else. Can you explain the makeup of the squeeze indicator, et cetera, et cetera? Yeah, Pedro, I'm gonna go through exactly how it's set up and how it works on that intro, the $47 intro class. So if you're newer to the squeeze, I highly recommend it because it takes about an hour for me to go through and kind of explain that and lay it all out. But it'll make perfect sense. Do you manage trades going against you, or do you get out at a certain percentage? So that's a great question. So here's because there's a lot. There are some trades that you're in that it actually makes sense to defend it, which means kind of selling some premium around it and kind of working your way out of it. And then there's other times that the best defense is to get out. Okay. Today was a day like, okay, just get out. Why? Because the internals, the way that they were reading, all right, the 21 period movie, it's just like, okay, is this the day to defend or is this the day to get out? Let me look at my list. Oh, it's a day to get out. Get out. I'm always a believer in shooting first and asking questions later because reentry is only a commission away. Let's see what else here. But when is this class? So the class is going to be on Saturday. So on Saturday, what I'm going to do is I'm going to do a 2-hour session from 9:30 to 11:30, and that's just for people's like, you know what? Okay, this is this is kind of a lot of stuff. That squeeze look cool. I'm not really familiar with you guys, but I'd like to kind of kick the tires. Completely recommend this. If you like it, you could have the chance to dive into the next part of it. But from 12 to 5, what we're going to do is, that's going to be the deep dive. That obviously includes this. And then if you want to do the live trading, I always say the live trading is like this. Like if you spent the weekend reading a book on how to play golf, okay, and then on Monday you went to the course and you started swinging the club, you would know kind of the general idea of it, but you really wouldn't hit the ball that good because you didn't really have any actual practice. You didn't have any actual practice, and you didn't have like somebody who knew what they were doing kind of watching you. And so that's the idea of the live trading, is that you can actually practice with someone watching you. You can ask questions. You can see me and what I'm doing real time. All right, so this trade, it's working, great. How do we get out of it? When do we get out of it? Or this trade's not working, what do we do? And that part I found is super, super useful. All right, fantastic. All right, guys, let me scroll down here. Why don't you do a 3-day in Minneapolis? What's funny is we actually used to, and by the way, this is the 3 days of live, the 997, the 3 days of live. I guess I should clarify that. That's online. So you can do that from the comfort of your own home, which is great. And this one will be live. This is in Austin. We used to do more, like maybe 5 or 6 live events a year. The biggest problem with that is that we don't teach by what I call PowerPoint. Like when we're doing live trading, or when we're doing a trading seminar, we're live trading. And a lot of times you just don't know what kind of internet connection you're going to get. And so we've been in situations where we've got a room of 100 people and we're all trying to trade and the internet sucks. And it's just like, oh my gosh. And so, what happens is when we find a location, we kind of stick with it. And so, we've been doing stuff at the Mandarin Oriental in Las Vegas. Great location, amazing hotel. And the internet was solid. And then we found this place in Austin, the AT&T Center, and it's been the best. It's kind of like the Booth Center in Chicago without the $97 a day parking. So it's kind of stadium seating. Everybody can bring a laptop. They got their own power outlet, and the internet's on fire. So it works out really good. Yeah, and Robert, by the way, that is something I do. At some point, I think that's probably going to be the path of what happens. All right. All right, guys. Well, awesome. So thank you for hanging out with us. I'm gonna leave this up here. So if you guys have questions, and again, this is, if you're unsure, it's like, wow, this sounds interesting, I'm not sure. and you don't know who we are, this is a no-brainer. I mean, it's just you'll learn so much from this, just in terms of kind of how the markets really work and some setups that you can use. And then from there, if you want to dive in, I mean, this includes the triple squeeze indicator, okay? And then the live trading includes the triple squeeze indicator and the expected move indicator. And this it's just gonna be a lot of fun. Oh, you want times and stuff like that. So if you scroll down, well, that's if I could actually bring up the web. Let me bring up the web page here. And so the class is Saturday, and that would be this Saturday. So if I type in shadow, all right, if you scroll down, you'll see more specifics. Okay, so you'll see, oh, okay, great. This is going to be on, this one, and these are all Central Time, right? And then you scroll down here, and you'll see the dates, and scroll down here, you'll see the dates and the, what else is included and all that kind of stuff. Okay, and then the live event as well. So if you scroll down, it'll answer all those questions for you. And of course, you can call us and all that fun stuff too. Okay, guys. All right, we'll leave this up here. This is going to be an awesome class. I think this is going to tie together a lot of stuff. Especially if you've been with us for a while. This is going to tie together a lot of stuff. If you're newer, man, I wish I could have started out of the gate with this kind of stuff. I mean, I was getting excited. I was like, Eric on Sunday was trying to do yard work and stuff like that, and I kept calling him like, "Oh my God, did you see this? How does this work?" And he's like, "Yeah, John, I know." And so I get pretty excited about this kind of stuff. Anything that kind of can give us an edge, I'm all about that. Yeah, good question. So a couple people asking about the account size for the class. So the account size, I mean, look, if you've got like say $300 to trade with, that's going to be a little tricky. A lot of our folks that are trading are anywhere from a couple $1,000s up to 7 figures. So it's the beauty of this is that the beauty of options is that no matter, even on something like Priceline, you can construct a trade that's appropriate for any account. And that's what's nice about options. I mean, obviously, even it's hard to buy, and I'm just saying Priceline as an example, but it's hard to buy a, or even like a $300 stock in a small account. But with an option strategy, it doesn't matter. Like you can say, you know what, I don't want to lose more than $200. Great, you construct an option that can't lose more than $200 and potentially has more upside and is high probability. Yeah, and if you can't make it Saturday, this will be recorded. What we do with these prices is that these prices are good for, kind of prior to the class. And then after we do the class, they actually go up. So I encourage you, if this looks interesting and you can't attend, get the class now, because at least you lock in that lower price. And then you'll have the recording, and obviously you'll get the indicators and all that kind of stuff. If we are not approved for spreads, will the strategy still be beneficial? Okay, great question. The answer is absolutely yes. I base so what I'm doing this stuff, I'm basing it purely on direction. Okay, here's a stock that has a higher probability of going higher. Right? We're not looking at the Greeks. We're not talking Vegas and all that kind of stuff. So if you've got a smaller account, you can only buy a call or buy a put. You don't understand Greeks, you'll be just fine. And it's one of those things where, look, if you're more advanced and you understand all that, that's great. You can utilize that stuff, but it's not a path that I'm going to go down, because it's really more about finding that edge in directional order flow. All right. Excellent, guys. Cool. All right, I'm going to leave this up here for a little bit. Thank you guys for joining us. Super excited about this class. You guys are, it's like that guy in Men's Warehouse. You're going to love the way you look. You're going to love this class. It's going to be a lot of fun, and looking forward to work with you. All right, have a good one. For those of you that are in the room, I'll see you tomorrow. For those of you that are hopping in on Saturday, I'll see you there.